Pest, Sinyakote, Trumnetitewis, Squidiot Squest, Chenes Sailor Skose, Unkulen Chumkanehu. Good afternoon. My name is Casey Lozar, and I'm an enrolled member of the Confederate Salish and Kootenai tribes from the Flathead Reservation in Montana. And I'm the director of the Center for Indian Country Development, or CICD. The Federal Reserve Bank of Minneapolis has long focused considerable attention on providing research that illuminates the CDFI industry, and in particular, native CDFIs, given CDFI's importance to economic and community development. I'm thrilled to welcome you to this afternoon's conversation on the unique lending practices of native CDFIs. We're honored to host this webinar in partnership with the Native CDFI Network and the Opportunity Finance Network, or OFN, as part of OFN's regional meeting taking place at the Federal Reserve Bank of Minneapolis. To those of you who are together in Minneapolis, and to those who are joining online from across the country like myself, I welcome you to the second event in CICD's 2023 webinar series on cultivating native economies in the 21st century. Our conversations this afternoon take place at an exciting time for the native CDFI industry. Native CDFIs are a vital source of credit and financial services in Indian country. And now the research is catching up and helping us tell that important story. Recent studies have shed light on native CDFI's success with clients who have limited credit histories and have provided evidence that native CDFI's relationships with their clients and knowledge of their communities they serve make a difference. These findings validate the unique characteristics of native CDFIs and offer valuable insights for financial institutions in Indian country and beyond. This afternoon, we'll hear new research on native CDFIs lending practices and how these practices affect client loan outcomes, followed by a conversation with native CDFI leaders who are on the front lines of these issues. We're incredibly fortunate to be joined today by Pete Upton, CEO and chairman of the Native CDFI Network, Lakota Vogel, executive director of Four Bands Community Fund, and Adrian Smith, senior vice president for research at the Opportunity Finance Network. Each of these leaders has dedicated themselves to advancing the collective industry. And I want to thank them for the time and expertise they're sharing with us today. Because this webinar is taking place in association with OFN's regional meeting, we have the opportunity to host this panel in person as part of our live stream event. And before we launch into our conversations, I want to encourage you to stay tuned for details on future events in CICD's 2023 webinar series. This fall, we'll take a deep dive on tribal broadband, and in December, we'll share new data tools available to support economic development in Indian country. Our series launched in June with an event focused on the growth in native federal contracting, and a recording of that event is available on our website. It is now my honor to introduce you to Lakota Vogel, Executive Director of Four Bands Community Fund, who will provide an opening blessing for our time together this afternoon. Lakota?
Thank you all. Thank you, Casey. As mentioned, I'm Lakota Vogel with Four Bands Community Fund. So I just wanted to start this meeting in a good way with a reflection and a little bit of a prayer. So, thinking of any way that you pray, just reflect and meditate on some of the thoughts that I have today. And one of the things I always remember when I come here is speaking to those that are here, that are present, and those who are absent. So I hope today that we all are here present in good heart, good mind. We keep our communities in the forefront of our mind of all the lived experiences that we've heard, that we've lived, and that we've shared. And we use those to speak through us as we present our reactions to some of the research and think about the future going forward. So that's a quick reflection, but I just hope we all keep that in mind, and we look forward to the questions and answers to come.
Well, thank you, Lakota, for your wonderful words to help frame our time together this afternoon. It's now my pleasure to introduce you to the CICD colleagues who will facilitate our conversations. CICD Project Director Mishu Kokodoko and Research Fellow Laurel Wheeler are part of a team of researchers who have contributed new insights and proof of concept to the native CDFI industry over the past few years. The power of this research team is that it includes content experts and economists bringing together research rigor with practitioner wisdom. I want to thank Mishu and Laurel, along with CICD research partners Valentina Dimitrova Grazel, Peter Grazel, and Joseph Guzzi for their groundbreaking work in this area. As part of this afternoon's panel discussion, we're looking for questions from the audience. For those of you who are in person, please record your questions in the index cards located on your tables. An event staff will come by to retrieve your cards. For those of you who are joining online, please share your questions through the Q&A function in Zoom. We'll get through as many of your questions as our time allows. I will now turn it over to Laurel Wheeler, who will share some of her recent research. Thank you all for joining us for this important conversation. Laurel?
Okay, thank you, Casey. Hi, everyone. Please let me know if there are any issues. Hopefully you can see my slides and hear me okay. I am very excited to be talking to you today about our work on native CDFIs, lending insights, best practices, and policy levers. I would just start with this disclaimer. As always, the views presented here are the views of the authors and not those of the Federal Reserve System. And I'm going to begin with an outline. So I'm sure many of you are familiar with this industry already. I'm going to very quickly begin with an overview that discusses the role of native CDFIs in Indian country. Then I will divide the presentation into 3 parts, wherein the first part focuses on lending insights from the native CDFI industry. The second part focuses on native CDFI practices, in particular assessing client risk and client counseling. And then I'll end with a discussion about some policy levers. So everything I talk about today is based on what my colleagues and I have learned through our research. And throughout the presentation, I will discuss how this research was made possible through collaborations with CDFIs that shared their loan level data and or participated in interviews with us. So by way of overview, we know that credit is necessary for pursuing economic opportunity and enhancing financial security. This is true for businesses, it's true for people, it's also true for governments. Unfortunately, credit has been undersupplied in Indian country, and that's for a number of reasons, including that Native communities have been underserved by mainstream financial institutions. One recent survey by the FDIC shows that approximately 16% of American Indian and Alaska Native households have no account with a bank or credit union. And even when financial institutions do exist in or near Native communities, there may be a mismatch between Native culture and banking culture. So Native community development financial institutions for Native CDFIs, they help fill this credit supply gap in Indian country. Sorry, I'm just moving a window. So Native CDFIs are an increasingly important source of credit and financial services. They serve low to moderate income communities and other distressed markets that are not fully served by traditional financial institutions. There are currently 65 certified Native CDFIs. We know that Native CDFIs do predominantly serve American Indian, Alaska Native, and Native Hawaiian borrowers, but not exclusively. Most operate on tribal lands or are managed by tribal citizens, but again, not exclusively so. Now, Native CDFIs can be for-profit or not for-profit, but importantly, they have a social and educational rather than a for-profit only mission. So Importantly, there is a lot of variation across Native CDFIs, of course, but one common thread is that they design their services with culture and relationships in mind. So, despite the importance of Native CDFIs, unfortunately, up to now, there has been a relative lack of research kind of systematically documenting the work of Native CDFIs. So my co-authors and I are seeking to fill this gap in the literature with an ongoing research agenda that really better seeks to understand the operations of Native CDFIs. Toward that end, we are documenting lending operations. We are studying how borrower and loan characteristics affect loan or predict loan performance. We're studying the link between financial training and loan performance. We have held listening sessions and interviews with 45 CDFIs, and we're currently in the process of transcribing the interviews that we held, the lessons from which are invaluable in their own right, but they will also be used to inform the development of a comprehensive quantitative survey instrument, which we do plan to administer in the coming months. So now I'd like to talk about some insights that were generated as part of our research. And for these particular lending insights that I'm about to share with you, we rely on unique loan level data provided by Native CDFIs. So our data specifically were obtained by Oista Corporation and Sweetgrass Consulting, who, with appropriate permissions, shared the data with our research team. The data come from 11 Native CDFIs. These CDFIs are representative in terms of loan products, portfolio size, and loan disbursement, and they do represent a range of geographic regions. Also, they represent, in terms of lending volume, 15% of the industry total. So we don't have the entire universe of Native CDFI loans in our data set, but we do have a relatively representative sample. So altogether, our data set includes more than 2,000 loans. These are business loans, home loans, and other consumer loans. These loans have closing dates from 2003 to 2021. The majority of which are after 2015. And we also have loans in the data that are active, paid in full, and loans that have been declared bad debt and written off. So that's a little bit about the data. What did we learn from the data? What did we learn from studying these loans? The big takeaway is that Native CDFIs appear to be fulfilling their mission. They are providing a variety of loan products across different loan categories. So you can see on the slide some of the different loan types that are represented within each of those loan categories. And also Native CDFIs are providing loans of different sizes. This figure shows you the distribution of loan amounts by loan category. You can see that the lending amounts are spread across the distribution. The different shades correspond to different loan categories. So you can see that the distribution of lending is not the same for each loan category. That probably doesn't surprise you. One pattern I'd like to draw your attention to is that business and home loans tend to be larger than consumer loans. That being said, Native CDFI loans do tend to be relatively small on average. So the majority of these business loans would be considered microloans, and many of the consumer loans would be considered credit builder loans. Overall, the mean loan amount is less than $34,000. And again, I think this gets at the idea that Native CDFIs are supporting borrowers in varied circumstances. We see that credit is extended to businesses as old as 23 years old, as well as to brand new businesses. And the borrowers range in age from 18 to 96. Based on our data, we observed that 50% of these loans are going to women and 83% are going to American Indian, Alaska Native, and Native Hawaiian borrowers. Now, not only do we see a distribution of lending amounts, we also see a wide distribution of credit scores for the borrowers. So credit scores are distributed across the spectrum. I'll show you in a second. And this would include thin files. So basically thin files are when borrowers don't have a credit score at all. We don't always know why that's the case, but it often means that that effectively, there was an insufficient credit history to allow for a calculation of a credit score. So here is a figure showing you credit score by loan category. And you can see the credit score distribution here for consumer loans is sort of shifted to the left of that for home and business loans. You can see that there's quite a bit of representation on that left tail, even as low as in the 400s and 500s. So those were just quickly some of the main insights from that first part of the research. And now I'm going to rely on that same data set based on the loans of those 11 native CDFIs to talk about the practice of assessing client risk. So native CDFIs, just like other financial institutions, assess client risk in an effort to reduce delinquency. Up to now, there hasn't been a lot of systematic research examining which loan and client characteristics really predict loan outcomes. Of course, some CDFIs do their own research, but this typically isn't done in a systematic way across organizations. And why is this question important? Well, we need to know what characteristics predict loan delinquency because loan delinquency affects CDFI financial viability and it hampers future lending. And as we know, mainstream institutions use information about things like credit score and household income to kind of mitigate the delinquency risk. But also credit score might be a weak signal of borrowers' creditworthiness in underserved markets in particular. So what is the optimal way for native CDFIs to assess the risk associated with their clientele? In our research, we addressed the question, what is the relationship between loan and client characteristics and delinquency? And we consider a number of different factors that may be predictive of delinquency. So those factors do include credit score, which I mentioned on the previous slide, and we also consider household income. In addition, we consider demographic variables like age, gender, and education. Importantly, in our analysis, we also consider some of the innovative measures that are employed by native CDFIs, measures that utilize community-specific knowledge and relationships. And so these factors can include things like the character score. This is a score assigned to the borrower based on a variety of factors, such as, their role in the community, support networks, relationship with the CDFI, reputation in the community, overall financial literacy, and things like that. We also consider commitment to business, which is another determination made by the CDFI about the borrower based on this community-specific knowledge and relationships. And then finally, we consider client engagement, which is a measure of how engaged the borrower is perceived to be by the CDFI. So I do want to note that the character score and the commitment to business score are measures that were pioneered by Forban's Community Fund. So I'm going to share with you some of the high-level takeaways from our delinquency analysis. First, our findings suggest that conventional measures of assessing risk are sometimes effective. So again, one of the most commonly used measures of risk, as I mentioned, is credit score. And we find that in most cases, credit score is negatively associated with delinquency. So just to give you a sense of how to interpret that, what is the size of this effect? If we look at all loan categories combined, a 100-point increase in credit score reduces the probability of delinquency by 7%. Another commonly used measure of risk is household income. And in the context of consumer loans, we do find that household income is negatively associated with delinquency. So that means that borrowers who come from higher income households are less likely to have delinquent loans. However, interestingly, that relationship does not hold for the other loan categories. So for business and home loans, household income is not a significant predictor of delinquency. So now let's turn our focus to unconventional measures. We find, again, that these are sometimes effective in predicting risk. So in the case of business loans, we find that character score is strongly predictive of delinquency. This means that borrowers who are perceived to be of higher character are less likely to have delinquent loans. And note that this is just identified off of the data we got from Forban specifically. We also find that clients that are considered somewhat engaged are less likely to have delinquent loans than clients that are considered completely unengaged. However, we don't find any evidence of a relationship between commitment to business and delinquency. So I think actually one of our more interesting results is that in some cases, unconventional measures of risk may be more effective. So you'll recall I said that credit score is predictive of delinquency. Well, when we include both credit score and character score in our analysis, character score is more predictive of delinquency than credit score. So in analysis with both measures, credit score really does not provide additional information about risk. In summary, here's what we can say about the native CDFI practices around assessing client risk. Our analysis suggests that lending models that incorporate borrower level information going beyond credit score and income may be well suited for native CDFIs. And in particular, we find evidence that character-based and relationship-based lending might improve loan outcomes. So the second native CDFI practice I'll delve into this afternoon is client counseling. Just by way of background, this financial counseling is one of the innovative lending strategies of native CDFIs. It is part of the client-centered approaches that really lie at the heart of the native CDFI mission. So most CDFIs do offer borrowers the opportunity to participate in financial counseling. And this counseling tends to be free of charge and provided by the native CDFI staff. So counseling usually starts shortly before and continues within a few months of the start of the loan. Borrower participation is typically voluntary, but it's often recommended by the CDFI, and it's frequently requested by the borrowers themselves. So despite the prevalence of this practice of financial counseling, the literature on credit default has largely overlooked the role of client counseling. And so in our research, we set out to examine whether these practices undertaken by lenders to sort of aid and support clients, as opposed to supervising them, whether they could be an important determinant of loan outcomes. For this research, we rely on a different source of data. Here, our data come from one native CDFI. We have loans from 2008 through March 11th of 2020. That's the start of the pandemic. And we have 441 consumer loans in this case. So the data set contains different types of information, including loan outcomes. Again, we observe if a loan is paid in full, if it's been declared bad debt, or if it's still pending. In our data, we also observe borrower exposure to native CDFI provided financial counseling. So we can actually differentiate whether it is coaching or training. The training occurs in a class-like format, and it focuses on financial literacy skills, whereas coaching takes place more often via one-on-one meetings. In our data, we also, of course, can observe several loan and borrower characteristics, including things like credit score. So based on these data, we can start to think about who receives counseling and how much. In our data, 28% of all borrowers received some counseling, and borrowers with a credit score were more likely to receive counseling. That might seem a little counterintuitive at first, but the borrowers with credit scores are taking out larger loans, and larger loans are inherently riskier. So the CDFI typically will assign counseling when it assesses the inherent risk to be the highest. And also, so conditional on receiving at least some counseling, the median exposure to counseling across all different categories, borrowers with a credit score, without a credit score, the median exposure is only 0.5 hours or half an hour. So the big question we wanted to address is whether counseling affects the prospects of bad debt. I'm going to go ahead and give you the answers based on our research findings without getting into too many of the technical details just for the sake of time. So we find that counseling is associated with a reduction in the prospect of bad debt, but only when a borrower has a thin credit file. So in this case, counseling is associated with an 82.1% reduction in the prospect of bad debt. We find that counseling does not affect the likelihood of a loan turning into bad debt if the borrower has a credit score. We also find that the intensity of borrower exposure, the intensity of borrower exposure to counseling matters as well. So exposure to less than half an hour of counseling is not effective. But for borrowers without a credit score, half an hour or more is associated with 87.8% reduction in the prospect of bad debt. Just a few other results from our analysis. We find that the effect of counseling is approximately equal to the effect of possessing a credit score. And one further result is that we find that coaching is more effective than training. This, however, was identified off of a small number of observations. So I would say that a bit more research needs to be done on this question before conclusively inferring that coaching is more effective than training. So the last thing I'd like to touch on today are policy levers. I want to be clear that we are not necessarily advocating for specific policy changes. We're not claiming to be comprehensive in terms of covering all relevant policies, but the goal here is just to highlight some of the issues of consideration that were shared with us through interviews with Native CDFIs. This effort actually kicked off with a series of listening sessions or focus group interviews with Native CDFIs. We asked questions about their challenges, industry opportunities, and what they would like to learn from others in the industry. We used those listening sessions to develop a list of interview questions. And then in the summer and fall of 2022, we conducted one-on-one interviews with the leaders of approximately 50 Native CDFIs. The interviews were set up by the CICD, but they were actually conducted by staff at OISTA. And the questions that we posed were all open-ended. So we didn't want to seem overly prescriptive. We were really interested in giving Native CDFIs the opportunity to shape the direction of our research. And the goal here was really to learn about what matters to Native CDFIs. So I'm going to focus on 3 sets of insights from those interviews. First, I'm going to talk about what we learned about the unique ways in which Native CDFIs tailor their products and services. Second, I'll highlight some of the government requirements that make it difficult for Native CDFIs to access capital. And then finally, I'll talk about some of the policy changes that would allow Native CDFIs to better meet community needs. In terms of tailoring financial products, we heard several things from Native CDFIs about their practices that set them apart from conventional lenders. Some of the most common themes are listed on this slide. So we heard that Native CDFIs are more likely to close loans that conventional lenders might consider high risk. Also, Native CDFIs place value on relationship building and trust. Native CDFIs often help with closing costs, and they keep interest rates low and they keep the terms as long as possible. This was often referred to as patient capital. Many Native CDFIs will consider artwork as collateral, and many of them offer credit builder loans. One key objective is to make sure that the loan is not hurting the borrower, and this principle shows up as a common thread across many of the practices I'm mentioning here. Native CDFIs also tailor their development services to the communities that they serve in unique ways. Again, I've just listed some of the most common themes on this slide. So importantly, Native CDFIs do provide a lot of financial education and literacy classes. Native CDFIs may also use storytelling in their lending practices. They offer youth programming, and they work with elderly centers to teach about scams. Native CDFIs also develop educational programs for people who live on fixed income, and they use curricula that are tailored to Native communities. So one program that we heard about often was the Indianpreneurship Program, which is kind of a suite of products developed by Onabin. So now let's talk a bit about the restrictive government requirements. So the federal government is an annual funder, which means that federal grants are typically only 1 year. And this tends to be short-sighted. Native CDFIs do typically need multiple years of funding. Also, government grants typically have strict reporting requirements, which really imposes a high administrative burden on the CDFIs. Compliance is very cumbersome and time-consuming. This can become impossible for Native CDFIs with small staff. And government grants also typically have multiple portals for reporting, which can be really administratively costly. Also, the government typically requires an amount of loans receivables that just might be too high for most Native CDFIs to meet. And much of the available funding is project focused. It's not always easy for Native CDFIs to meet this requirement. Similarly, a lot of the grants require matches, which can be hard to find. I'm sorry, it keeps doing that. So what can be done? Now let's think through some of the kind of the policy levers that could alleviate some of the constraints. First, an obvious solution to the 1-year grants could be longer term funding. So for example, 5 years instead of 1 or 2 year grants. CDFIs have repeatedly told us that these would be more appropriate for community building purposes. Also, there's a need for operating capital, not just lending capital. This would pay salaries and overhead. It would cover the cost of compliance and reporting. It would also cover the cost of lending technology, which can be quite expensive. Another suggestion would be to have grants that have tiered levels of access to funds, which would allow small CDFIs the opportunity to access funds. We also heard a couple of times that there would be some demand for increased clarity in the guidelines for lending on versus off reservation. And importantly, new policies should really be, a new program should be developed in consultation with Native practitioners. And this would really help ensure the effectiveness or the appropriateness for Native CDFIs. So we're still in the process of analyzing the transcripts from the interviews. We will have much more comprehensive insights prepared in the coming months. And we do plan to write a paper summarizing our findings, which we're happy to make available. Please don't hesitate to reach out to me if you would be interested in reading any of the papers that describe the other research I referenced in this talk. My email address is listed on the slide. Just thank you so much for your attention. I look forward to the discussion, and I will hand it over to Mishu now.
I also want to mention that at the end of the presentation that Laurel had, some of the recommendation, or what you might call policy recommendations, were actually from the CDFIs that we talked to. So not necessarily recommendations from the Federal Reserve Bank or from the CICD. Very good. That was quick. Thank you for joining me on the stage. For the benefit of those online, maybe we can just take 1 or 2 minutes to introduce yourself, your organization. Maybe we can start with, let's see which way I want to go. I get to choose.
You said Adrian. I thought the group.
Why don't we start with Lakota, Adrian, and Peter?
Hi, everybody. My name is Lakota Vogel. I'm with Four Bands Community Fund. We're located on the Cheyenne River Sioux Reservation in north central South Dakota.
And my name is Pete Upton, and I am the CEO of the Native CDFI Network and also the Executive Director of Native 360 Loan Fund. And we serve all Native Americans that reside in Nebraska, Southeast South Dakota, Iowa, and Kansas. And the tribe that I'm from, the Ponca tribe of Nebraska, we are a non-land-based tribe, which means we have service counties. So those service counties are 17 service counties, and that's how we do what we do. You know, we're not a reservation-based, but we will lend on reservation.
Hi, everybody. I'm Adrienne Smith. I'm the Senior Vice President for Research at Opportunity Finance Network. Opportunity Finance Network is a national association of CDFIs, and we're headquartered in Washington, D.C.
Thank you very much. So you've been invited to offer some comment and respond to the presentation that Laura gave. So I want you to maybe talk about 4 things. First of all, did you like the paper? If you did, we want to know why you like the paper. And also, maybe you can tell us how that research can change the work of Native CDFIs. And then, of course, at the end of the presentation, Laura talked about some policy consideration. Maybe from your perspective, as you read the paper, as you thought about it, what are some of the policy issues that were raised? Or what is the connection between the research and the policy issues? And then at the end, maybe if you have any suggestions for improving the papers, we're willing to hear that. So again, we can kind of go. Start with you, Lakota.
Well, first of all, I like the papers. But I think the important thing for me is, one, just working with CICD was, in all of this data, is really helpful. It's a little bit comical to see how we define ourselves, like quoted back at us with Kokodoko as the last name and cited as a resource. It feels interesting to me that we can say these things, but when CICD publishes stuff like that, the notoriety and the press that it gets and it just elevates it to another level, which is something that I'm unable to achieve as a practitioner in the field, and I'm really grateful for that amplification from CICD, so it's great to have it there. A lot of it was very straightforward in how we run our operations. I appreciate that. It's actually in a paper that we can now cite back to our funders about sort of justification of the market, right? And that's sometimes all you need. And I really strongly believe in the importance of data sovereignty for Indigenous communities. So I'm going to kind of reflect on that a little bit, but I do see it reflected in these papers. I really believe that data does not make itself, right? That data is created and shaped by the perceptions of the makers. And so how you perceive is how you proceed. And so in our community, we were the decision makers on which data to collect. We decided which data not to collect. And all we had to do was put that into a format that fit some researchers' sort of profile of their Excel and how to tabulate the findings. And the fact that we were able to make those decisions at the front end of what to collect and what not to collect helps tell the story in the way that we wanted it to. We have to remember that a lot of the questions we ask our markets are sort of hidden behind the illusion of objective methodology, right? These are dominant society questions that we never think about unpacking. And I think in this opportunity, in this moment in time, we actually are at the table, our voices are here, we're able to sit with a team of researchers and unpack the questions that we want to ask and define, and then even further go into the analysis. And so I think that we want to remove ourselves from being the object studied. We're always the object of study. We are something to be studied because it's always through the lens of deficit. Always. Native Indigenous voices are a deficit. We know the data reality, but it's not our lived reality. And so this was really an opportunity to talk about the positives that we've been contributing to an industry that our voices just really weren't present in. So overall, loved it. We need more of it, but those were my highlights. Some things in the data that I was thinking about was, this isn't just good practice for Native CDFIs to do. To me, we need to know what predicts risk for all financial institutions. Does collateral equity predict risk in your portfolio? Let's say that to the banks of the world, right? All of us should be looking back and seeing if those things really are predicting risk. And I think, centuries-old financial frameworks just aren't fitting the rural Native markets that we're serving. We've identified it, but we wanted to lift this up as a challenge to everybody to do a quick study, look back, a regression analysis on 100 small business loans in your portfolio and see what is predicting risk, because the way that we're doing it is limiting and it's excluding a lot of our communities. Another quick thing about this is it shows credit risk is negatively associated with delinquency, which seems like but it's also because we spent 20 years building the credit scores in our community. So like that's an analysis or an implication of the study that's left off. We actually recalibrated the credit reporting framework in our community in Eagle Butte. We actually create a system for our borrowers to report to credit bureaus because it didn't exist, right? So that's a part of the reason why it was associated and those things were left out. But, and it also made me sort of cringe a little bit about character score. Just that word is dangerous in the hands of the wrong people, right? So like me as a practitioner now, I'm probably gonna go back and relook at the word character score because we know what it means and we've explicitly defined that, but we need to be careful about what the industry does with that knowledge, right? So it's just one of those things when your stuff is said back to you by objective researchers, you're like, ooh, if that was said in the wrong audience, that could go a different way, right? So those were just some immediate reactions. I'm sorry I didn't get to the other questions, but love the work and I'll hand it off to Pete.
Go ahead, Pete.
Okay. No, I thought the study, hit the nail on the head when it comes to what we do on a daily basis. We, we make loans to, sometimes we're the last resort for an individual coming in to get a loan from us, and that's one of the first things that we look at. We always look at character because I think character is the number one aspect of lending, especially in the markets that we lend to. And the way that we do the analysis might be a little bit different, but a lot of times it's over a series of 2, 3, 4, 5, 6 meetings, one-on-one, to get a consistent read on who we're lending to, because at the end of the day, it's the person sitting across the table from you that you're making the loan to. And I know there's a lot of outside factors that determine delinquencies and sometimes things that are out of their control. I always tell my borrowers, it's not like one day you're going to wake up and say, hey, let's make Pete's life miserable and not pay him, maybe it's the economy, maybe it's things that are going on at home, and those are the things that I want to find out about. So I thought the study, hit the nail on the head when it comes to what we look at, but I think there's a big difference when it comes to consumer lending and when it comes to business lending. And then also, we have the best success on loans that are above $5,000. We have the best success on loans of $50,000 to $150,000. And I think at that point in time, I wouldn't say that there is and I don't want to downgrade someone that has a small micro business, but at the end of the day, sometimes there's greater risk when it comes to small micro businesses than maybe a contracting business. So at the end of the day, I think it's the outside factors that'll determine those delinquencies to a certain degree. And when it comes to consumer lending, what we find is similar to what your report found there. We struggled with financial literacy in our community, and one day we came up with this wild idea. I know everybody will cringe that comes from the native world, but we decided, well, we're going to offer Dave Ramsey, and our phones exploded. And we had like 180 people sign up in a 6-month period. And we had families coming, and they started living by his methods and his. We utilized him until he went way over on the other side, and I said I can't do it anymore, so we don't utilize it anymore. And I've called him and I told him that. But anyway, it was very successful, and we even had business clients that said, we're not going to renew our loan, and I'm like, darn, we got you to this point, but they weren't going to renew it because they learned a good way of handling consumer debt. And now we've kind of taken an off spin of, I got to watch what I say so I don't get sued, an off spin of what they're doing, and we still utilize the teachings and the methods when it comes to consumer lending. So it's there's a big difference there, but I honestly don't believe in my heart that people wake up and say, I'm going to make Pete's life miserable and I'm not going to pay. Generally, I dig into it a little bit deeper and I find out why. And there's so many social determinants that play into play there, whether it be medical bills, whether it be addictions, whether it be alcoholism. And in our community that I serve, those are top of the list there. So we have resources available, but in getting into our loan portfolio, we have very few delinquencies and we have very few write-offs. And I think it's because what we try to do is once they have a personal relationship with me, and I meet with them, and there's community members that I meet with, and And generally, it's around a dinner, and it's very intimate. And I'll ask them how their business is going, and I try to make a tour of our community once, twice, 3 times a year, and that kind of explains. I like to munch and eat with them, and we have a good time. But we were meeting with a group in Yankton, South Dakota, and this one was on the Yankton Sioux Reservation, and there were about 10 to 15 around that room. And earlier that week, my sister gave me a list of Native American students in 1927 that got taken to the Genoa Indian School, and my mother's name was on that list. Well, as we were sitting there eating that evening, I noticed 5 or 6 other names on that list. And I asked him, I said, are these relation to you? Well, sure enough, they were a relation, and it's those bonds that you create when you're in those community settings. Their kin went to school with my mother, and I'm 1 generation away from a boarding school. So I think those are the types of relationships, and they kind of feel they're obligated to you, and you really get to know them. And I tell them, don't ever BS me, because any excuse you come up with, just be honest with me. Tell me what's going on with your family. And I think that's the way that we run our loan fund. And it's a phone call, and my phone is never off. I'll take a phone call on a Sunday night at 8 o'clock, 9 o'clock at night. So my time's up. But I never turn my phone off when it comes to my clients.
Thank you, Pete.
You bet.
How about Adrian?
So there's really a lot to like about these papers. I really enjoyed reading them and kind of digging into them. I just want to note something that the authors, like a very simple point. The authors say the papers provide one of the first systematic quantitative inquiries into the lending practices of Native CDFIs. And like that's an important statement, right? And I think it's an important undertaking that we really need to commend them for, because I think one key to understanding and promoting the work of Native CDFIs is disseminating research on Native CDFIs and what they do. And really, one of the things that was kind of key in the papers is this partnership between the researchers and the Native CDFIs. The issues of data sovereignty and data ownership that Lakota was pointing out, you could really feel that in the research. You could really understand kind of this fruitful partnership between the researchers and the Native CDFIs kind of coming through in the studies. I really also appreciated kind of like the really thorough and descriptive analysis that the authors did. They really demonstrate what Native CDFIs are doing and how they're fulfilling their missions, and what makes them kind of unique lenders and unique in this space. Also, another thing I really liked about the papers is they were kind of careful in what they found and what they stated their findings were. They didn't overstate the findings. They were careful about caveating, explaining what the limitations and what the strengths of the analysis were. So really commend that work. I was thinking about what, Mishu, you asked us to think about where the research, what limitations or extensions of the research. And I really thought about ways that we could expand or extend on the research. And I thought one of the ways is, just about the generalizability of the findings. Like, yes, I think, like you said, I said, I think it's commendable the kind of data collection that you went and partnered with the Native CDFIs on. But can we extend the findings? You looked at 11 Native CDFIs. Can we include even more Native CDFIs? Do the findings apply more generally to a larger population of Native CDFIs? I also think one possible extension is just to look at other outcomes. So you focused a lot on loan delinquency. Can we look at an outcome of like getting to a yes in the first place, the deployment of a loan and the factors that predict how we get to a yes, and how financial counseling plays a role in that. Another thing I was interested in terms of like another extension of the research is predicting subsequent loans. So not just like that first deployment, but like how borrowers progress on their kind of financial, on their in growing their wealth and their just their strength as borrowers. Another way that I thought you could extend the research is just kind of going deeper, doing more qualitative research. So I know you looked at some of the policy implications and policy considerations that native CDFIs are really focused on. But I really wanted to also know more about the mechanisms through which financial counseling aids borrowers. So like, what is it? Not just like, yes, no, did they receive financial counseling, but like, how did that financial counseling help them successfully get the loan and also repay and successfully be a borrower. A final thing, kind of another qualitative thing that I thought you could look at is sort of an implementation study of that character-based and community-oriented lending. So like I know Lakota, you said you cringed about it, but really I wanted to know more about how that differs, how the character-based and community-oriented lender is implemented in one native CDFI versus another, how the practices are similar from one to the next and how they differ from one to the next, so we can really expand and extend on the character-based and community-oriented lender. But overall, really impressive research. I think the body of literature and what you're building here is really exciting. And I think there are a lot of policy implications which we can talk about as well.
Very good. Thank you very much. How about you, Pete and Lakota? Any suggestions for improving the study or the research?
You know, I think the study is exactly what the CDFI fund needs to hear. I hope nobody's in here from there, but they're wanting to take away from, you know, some of the technical assistance that we do provide, and everything in that study supports what we are saying is that we need the technical assistance, we need the coaching, we need the counseling, and it needs to be part of the NACA program. You know, if they want to take it out of the other program, that's fine, but I do think that the native CDFIs need to have that in their toolbox.
Okay, very good. Thank you. I think just
Yeah.
make sure to speak into the mic.
I think everything's been covered as far as research. I'm like she's saying, building a body of research. I think it's nice to know about the opportunity to communicate with CICD about future research opportunities we see needed in the industry and the field. I appreciate that open door, so I just maybe if we can announce that there's an open door policy for that type of thing, that's what I want people to know is, to me, it's felt like an open door of bringing us your ideas and we can explore if it fits in with our objectives of work and our, priority areas. So I don't know if that's widely known, but it should be, so.
Very good. Thank you very much. Maybe we can bring Laura back up. Maybe she can take a minute or so to respond to some of these comments. Can we do that? Any reaction to some of the comments, Laura?
Yeah, I just want to first thank the panelists. Thank you for reading the papers and for your comments. It's so great to have people reflect on the work that we've been doing, and I've taken a lot of notes on what you said, just to kind of quickly respond to a few of the things that you've mentioned. First of all, Lakota, we completely understand that a lot of the research we've done is merely documenting what everyone in this industry has known for a long time. And so we do see part of the value of the work as simply being able to provide a paper that others in the industry can cite and use as support. But we do hope that this is just the start, and we'll continue to grow the research agenda. I also take your point about kind of the sensitivities around the character score. If I had more time, I think we could talk for a long time about sort of the risks associated with advocating for or promoting the universal use of a subjective measure of risk. We need to be really careful about that. And I think part of the reason why character score is so effective is really this strong relationship that Native CDFIs have with their clients. And that really needs to be emphasized. And that is a really, really important part of the equation. And Pete, some of your comments as well about how there are so many social determinants to risk. I think that is a point well taken also. There are many different questions that we would love to be able to address with data if we had the data, and I think that's probably one of them. Also, one point that you made that I didn't have time to make in the talk, but this point about how there are very few delinquencies in general, that I think maybe that's a point that should be made more clearly, is we're talking about an industry that Native CDFIs in general have very low delinquency rates. And so what we're studying is delinquency within an industry where it's actually quite rare. And then, Adrian, thank you for all of your suggestions about the extensions to the work. I wrote these all down. I think, my co-authors and I will discuss these. A lot of them are feasible and I think would generate a lot of value. One of the things that we have talked about is, like you said, learning more about the mechanisms through which financial counseling does aid borrowers. This is something that we within our research team have talked about different ways that we could study this. And looking at other outcomes, we're hoping, we are hoping that, like I said, this is just the beginning, and we hope that we can build more collaborations with more CDFIs. We hope that we will be able to say things that are more generalizable, because we will have even more organizations that are collaborating with us, and data on more and different types of outcomes as well. So in short, I've appreciated all of the comments, and I'm looking forward to talking with my other collaborators and kind of processing and thinking about how we can implement these. So thank you.
Thank you, Laura. Maybe you can stay on the screen. We can take some questions now from our audience here and also from our audience online. We have some questions online, and maybe I can just encourage folks here with me to write down your questions on the index card that you have on the table. I have this question about character score, and I feel like I want to direct that to Lakota. Can you kind of explain a little bit how you arrive at computing the character score for a loan applicant?
Yeah, I think all of us in the room that are lenders have taken a framework of risk rating system, right? And so Forbands has one said character, and it's got some sentences underneath it, and it's a 1 through 5 score. But over 20 years of working within the community and understanding that, we really have built a wealth of knowledge within my lending department where they're asking and listening to the narrative of the borrower. They're asking questions to hear about how they've handled risk in their lives, right, before. Like, if you faced a difficult situation in your life, what has that done for you? We do some backup checking where we call the local financial institutions wherever they deposit money at and ask them about how that relationship with their depository institution has been. Like, there's a series of questions that we go through in order to determine that rating of 1 to 5, but never before have we had to explicitly explain it. And to me, it's about taking the implicit and making it explicit. And I think we're still on that journey. I mean, it's been instigated by this research of us trying to be like, wow, that, first of all, we were amazed that that was one of the predictors, the major predictor. And so then ourselves, for me, I wanted to make sure that I was taking that knowledge from my one director of lending who's been there the longest for succession planning and take it out of her head and put it on paper. And I think it's still a journey for us. But like I mentioned, it's because we are boots on the ground in our community, and I trust my team to have the right perspective about the person sitting across the table from them, and it shows up in the way we measure risk in our portfolio. So I don't have all the answers to how we look at that, but to me, the proof in the pudding is the fact that I have the right people sitting behind the desk and asking the right questions to judge that rating within our risk rating system. So I'll get back to you.
Okay, thank you. Maybe this one is for all of you. How can we foster industry partnership to address inefficiencies and leverage capacity building in the native CDFI industry. Maybe Pete, I can start with you.
Can you repeat that one time for me?
How can we foster industry partnerships to address inefficiencies and leverage capacity building in the native CDFI industry?
I think, really, I think sharing of knowledge, capacity building, or even leveraging resources, as industry itself. We don't always have to, we're working on a model, currently, and we'll see how it goes, but what we're looking at, but anyway, what we're looking at is to leverage a national, with CDFI network, if we were to do underwriting, if we were to do capacity building, grant writing, and things of that sort, to where we could offer that to our membership. So this is a little bit off of the Native 360, but it's more onto the Native CDFI network. But doing underwriting for our Native CDFIs, it's no different than me going to purchase a home a number of years ago. I met with the loan officer, and the next thing he says is, I'm going to introduce you to Michael, and he's going to do the underwriting. Well, then the next thing, Michael handed me off to a loan closing agent. And so I went through about 4 or 5 people, but they always told me who and what they were doing. And I think that would be ideal for our industry, because I see it when it comes to maybe fundraising, whether it comes to underwriting a loan, or even collections and things of that sort, to where we don't, as an industry, we're small enough to do these things, and we don't have to always have it done internally.
Thank you. Here's another one. How do you make native CDFIs available in native communities, such as those in North Dakota? Also, what is the measure of the quality of this community and impact? Who would like to take that?
I would say it's a Native CDFI network thing. How do you get another?
In North Dakota, we've, I do think our approach, regional, we have 9 different regions throughout the United States, and I think that's the approach we have to stick with, because I do get calls from North Dakota quite often, and it's making ourselves accessible to those regions. Just like last week, I was up in Alaska, and I met with some of the CDFIs up there, and until you get up in Alaska, you don't realize that they're truly landlocked. So I guess my answer to that question is, as the Native CDFI network, what we need to do is be accessible and offer any support that we can to the North Dakota groups, and find out what resources they have in place, and then what resources we can bring to them. As we get more and more expansion into the Native CDFI network, we're doing an event down in Gallup, New Mexico coming up in August. And it's very good to get our boots on the ground in those communities, and that's what we need to do better, and grow our staff. But it all comes back down to capacity of what we have, financial capacity, and then manpower capacity to do those. But I think we have to have boots on the ground, as many areas as we can, to continue to grow.
And I just want to respond to that a little bit with, there's a good website to find out the CDFIs that are operating in the country. So you can reach out to any one of them. And something about the industry is that we will willingly share our articles of incorporation, our bylaws, our loan policies, and you can duplicate, replicate. We can support you in developing a nonprofit. I do know of quite a few North Dakota ones that have started and are operating, so maybe it's just connecting you to the right people, but sometimes it's just a matter of knowing somebody, sending them an email, and we can usually connect you to a group. But I will say the CDFI fund does need to help with the recertification of target markets. Like, those applications are pending, they're not acting on them, for various reasons, and we need support in moving those recertification of target markets. So some of me in South Dakota could serve North Dakota. But we need the CDFI fund to relook at the entire recertification process currently, which is a policy issue that I will put on the table.
Very good. Thank you. Well, we all know that data recording is costly, and external grant support may be needed for data management and staff to collect and analyze data. So how can Native CDFIs use this research in a visit with founders and investors?
Did you want to talk about that, Adrian, just from your perspective?
I mean, I think the proof's in the pudding, right? That this research is valuable to have, and it will inform Native CDFIs work. Like Lakota, Pete, you're already reflecting on the research and using it to inform your practices. It also shows what Native CDFIs do, what they are capable of, and I think funders and investors need to support more of that research. It's not cheap. It's not easy to do. These partnerships take relationship building. They take time to do, but it's valuable to have that empirical research to show what is possible. I would also say that there's this tension always in the discussion throughout today about what's unique to a CDFI. At OFN, staff often say, if you've seen one CDFI, you've seen one CDFI. Well, yes, but there are also standard practices and processes from one CDFI to the next, from one Native CDFI to the next. And that applies to thinking about data and thinking about data collection and data management. So where can we get efficiencies across CDFIs? How do we build those efficiencies? How do we extend them to all CDFIs? And frankly, even thinking about building out that network and that data management type of thing takes funders and investors to support.
Very good.
Good job.
We have maybe one more minute for maybe one question. And this one is from me, actually. You're going to have to help me how to answer this question. So if someone were to ask you about whether the Native CDFI business model has a downside, what would you say?
At this point in time, I wouldn't say the Native relending loan fund model has a downside. I would say the Native CDFI four-letter word, CDFI four-letter, that's what's up for question for me, of if I need that stamp of certification in order to do the work that I'm doing. Like, if the fund moves in the direction it's moving in the recertification process, it'll probably eliminate me from being certified as a CDFI and serving my community. So does the CDFI word really do I need that in order to do the work of moving capital into my market? And my answer right today is no. So I don't think the business model itself is broken, but kind of unlatching yourself from that moniker might be a reflection that we're having currently and in the future. So,
thank you. Well, that's all the time we have for the questions. And maybe any final comment from our panelists before we conclude the webinar? Final thoughts?
I guess my final thought would be all the work that you're doing supports the work that we do, and all the work that OESTA does supports the work that we do. So, it's the more research, the more studies that are done on our industry, it really allows us to advocate to our policymakers and to our foundations that we need more funding and we need more flexible funding. And I think any research that you continue to do on this, I'd really like you to consult with us in regards to the challenges that we see coming down the pipeline, because I do think there's a train coming and we see the light, but we need ammunition to get to our policymakers to really stop it.
Very good. Thank you. Everyone here in the room would like to join me and thank our panelists.
thank you, Laura.
And to those attending virtually, I would like to express my gratitude for remaining engaged in the conversation. And now I would like to also thank our co-host, the Opportunity Finance Network and the Native CDFI Network, and also our colleague Laurel Wheeler for the presentation. You did a fine job. And of course, the entire CRCD staff who has been helping with this webinar. And once again, thank you, panelists. Now you are free to go now. Thank you very much. But also to end this, I would like to address an open invitation to everyone. Please watch for an invitation to join us in fall for the third webinar in the series, Cultivating Native Economies in the 21st Century. And the topic, as Casey mentioned, is going to be on tribal broadband. And registration will soon be available on our website. So again, thank you for joining us today, and we hope to see you in fall. Now we are adjourned.